If you ever had a real run on the paper market, it would be you'd break the market in a heartbeat, and gold would, as I say, it would
Bingo.
quadruple almost overnight. Was all the paper gold transactions in the world will never turn into physical gold. They cannot. It's impossible. There isn't enough gold, and if we even tried, gold would go to $1,000 an ounce so fast you couldn't. The ticker couldn't even keep up. Gold might be affected by the tariffs. It's like Trump put these tariffs on. They applied to everything. Now he's creating carve-outs, as he said. The auto industry, they're getting a 30-day pause, but the tariffs are extremely broad, so they would apply to gold in the first instance, unless he carved it out, which he hasn't. Having said that, it won't have any effect on the global price of gold. The reason is that gold is kind of like oil, gold, a couple other things. These are global prices. They're produced all over the world, not everywhere, but in every part of the world. They're consumed in every part of the world, and they're easily substituted. So if the U.S. doesn't buy oil from Saudi Arabia, we don't buy that much from Saudi Arabia anyway. We can buy from Venezuela. If Canada cuts us off, we can buy more from Mexico or more from Venezuela. But the same is true of gold. The price is set in two places: the London bullion market and the COMEX, the New York commodities market. And physical prices and paper gold prices vary. There's a lot to it. But my point being, if there's a tariff on gold coming from Canada to the U.S., we'll just buy it in Shanghai, buy it from Africa, buy it from Switzerland. The point being, when a commodity is truly generic, a car is not generic. You get a certain brand and a certain set of features, and it's electric or hybrid or whatever. Cars are not generic. Gold is. It's an element, atomic number 79. So the point being, when you have a generic, fungible global commodity, tariffs don't affect the price, because if you're getting hit with a tariff, you just don't buy it from that source, you buy it from somewhere else. Now, getting back to your other point, Danielle, about shipments from gold, yeah, it does appear that there was some kind of short squeeze emerging, and that shorts were having trouble getting physical gold to satisfy deliveries. Now, that can only go so far. If you look at, say, how do you get short gold? You sell gold futures on the COMEX, 1 month, 2 months, 3 months forward, and then you get to the end of the contract, and the buyer says, "I would like physical delivery, please. I don't just want to pair off or roll over my contract." That's a paper transaction. That's the way most futures settle. But if someone long the future says, "I'd like to take delivery, please," then yeah, you got to look at the warehouse and see what's there. And if there's not enough, you might have to get it from London or some other source. Now, that appears to account for some of the deliveries and some of the urgency about that. Having said that, there's a limit on that, and you have to read the COMEX rule book. I'm enough of a geek. I actually have read the COMEX rule book, but there are two important rules. Number one, they have a rule that says they can change the rules. So if things get tight or things get disorderly, they can just say sorry. No more physical delivery. We're trading for liquidation only. You can pair off your contract, roll it over, but you can't take physical delivery. They can just say that. And it is what they did to the Hunt brothers in 1980, I believe, 80 or 81, when they tried to corner the silver market. But there's another principle, which is also in the rule book, but it's just more broadly stated. Futures exchanges say, all of them say, we are not a source of supply. Now, it is true that you can provide notice and take physical delivery of the gold in a futures contract. That is true. But they only want a little sliver of that just to kind of keep the paper price and the physical price in line. By linking it to the physical price through physical delivery, in some cases, there's a little bit of an arbitrage, but not much. It basically keeps those two prices in line. That's the purpose of it. If all the all the longs got together and all put in notice of physical delivery, I promise you, by noon that day, the COMEX would say, sorry, trade for liquidation only. You cannot take physical delivery. We are not a source of supply. So this notion, a lot of gold bugs have it, that somehow you could use the futures exchanges to break the market. No, you can't. Only to a point. So, and it may be, I haven't seen any evidence that gold was being shipped to beat the tariffs, and we haven't even put tariffs on the UK or Switzerland. We probably will, or at least the UK, but not yet. And so I think there might have been a mild short squeeze unfolding, and that accounts for the physical deliveries, but that's not going to go too far because the futures exchanges can shut it down. In the scenario I gave where, too many longs, futures longs, put in notice of delivery, the COMEX says, sorry, too many, we're not a source of supply, trade for liquidation only. Okay, so that puts out that fire. But if that was a real demand, then where are those buyers going to go? They're going to go to the physical market, and then that, basically the London Metals Exchange and the London Ring. And that's where things could get very hairy very quickly. I've been talking a lot about this because Trump and Elon Musk are going to Fort Knox. So half is at West Point, half is at Fort Knox approximately, and there's a sliver at the Denver Mint for making gold coins basically. But that's it. So it's not all at Fort Knox, but they're going to go to Fort Knox, and they're not going to do an audit. I mean, to do an audit, you'd have these. You know what a gold bar, 400-ounce gold bar looks like. They all have serial numbers, assay stamps, refinery stamps, purity stamps, etc. You'd have to sit there with a ledger and take each number and compare it to the ledger, make sure they're all there, and adjust for the purity. Some of these bars, by the way, have been lying around since the 1920s. They're not 4.9s. They could be 97% gold. I'm not saying they're fake. I'm saying they could be 97, 98% gold. They're nowhere near 4.9s. 400 ounces, maybe. Some of them are a little gnarly. I'm not saying it's not there, and I'm not saying it's not real gold. It is. But if you're actually trying to price it out, you have to adjust for purity, weight, and basically the things I mentioned. So all they're going to do, it's going to be a photo op. So, by the way, if you've ever held one of those bars, it's like freeways. They weigh about 25, 30 pounds. But they're going to hold the bars up, see it's here, show you some pictures, and go away. That's not an audit, but it is like the mother of all photo ops. But I think it's a good thing. I think the American people have been lied to so much by the government on so many issues, from COVID to climate change, that they don't really think, a lot of people don't think the gold is there. Well, obviously it's there. Do you think that the Secretary of the Treasury would let the president go to Fort Knox if the gold wasn't there? So of course it's there. But here's the bigger question, the much more important question, and it gets back to what you were talking about, Danielle, with these deliveries from London. Is that gold leased? And that's a very big deal, because people don't understand, very few people understand gold leasing and how it actually works. They assume that if JP Morgan or Morgan Stanley or Citibank lease gold from Fort Knox, that somehow they back up a truck and take the gold away. No, that's not what happens. It's a paper transaction. I can lease it to you. We have a leasing contract. You pay me, the equivalent of rent, maybe 1%, 1.5%. It's a way for the Treasury to make a little money. The gold stays right where it is in Fort Knox. But in my example, JP Morgan would now have, as lessee, would now have title to that gold, and more importantly, a right of rehypothecation. That's a fancy word, but it basically means they can lease it to somebody else, and then that person can lease it to somebody else, and so forth. Is you have a chain of leases, or what are called sales of unallocated gold. So what's that? So I call up JP Morgan and say, I want to buy, 1 ton of gold. That's a lot of gold, but whatever, say 1 ton of gold. And they sell it to me unallocated. Now what that means is that there's no actual gold in the contract. In other words, it's not like I have bar numbers. I own it on paper, but there's no physical gold behind the contract. It's just, I basically have price exposure, and I can say I own it, but there's no physical gold behind it. So my point being, if JP Morgan leases the gold from the U.S. Treasury, which is entirely plausible, and then leases it to other parties or sells it on an unallocated basis, you very quickly get to a point, I think we're way past this point, where you could have 100 tons of paper gold transactions supported by 1 physical ton that got leased from the Treasury to JP Morgan. Now we're not talking about the futures markets. The futures market is a whole other thing, but we're talking about unallocated and leasing and rehypothecation.
Exactly.
So if I were Elon Musk or President Trump, I've spoken to people close to the White House about this. I said, while you're there, why don't you ask the Treasury if this gold is leased? Now, I'm pretty sure they won't ask that question, because if you do, you are tampering with the primal forces. You are getting at something. And you know who Blythe Masters is. Blythe was the head of global commodities trading for JP Morgan for many years. She's now, she's moved on to other things. She's been away from that for a while. But she said something some years ago, and I saw it and I verified it. Then I went back to find it and it was gone, like it was erased from the internet. But she said it. She said, gold never settles. And what she meant by that was all the paper gold transactions in the world will never turn into physical gold. They cannot. It's impossible. There isn't enough gold. And if we even tried, gold would go to $1,000 an ounce so fast, the ticker couldn't even keep up. So, in other words, as long as the longs and the shorts are happy and everyone's got paper gold, everyone's got price exposure, you make money, you lose money, whatever, but you don't try to turn it into physical gold, everything works fine. Gold never settles. You just roll it over or close it out or sell it to somebody else. But if you ever had a real run on the paper market, it would be, you'd break the market in a heartbeat, and gold would, as I say, it would quadruple almost overnight. Retail is a little more active, you're right about that, but they're not really driving the market. In a panic, they will, but it'll be too late. I mean, it'll be, I was saying buy gold at 700, 1,300, 1,900, 2,000. It's now close to 3,000. People just don't do it. It's fine. I'm not in charge of their finances, but people just don't do it. The funny thing is, Danielle, this is just human nature. When it like spikes to 4,000 or 5,000, then they'll run out and buy it. They could have had it at 1,300, but they'll wait until it spikes. That's just human nature. The big buyers are the central banks. They're the players. Some institutions, some hedge funds, but mainly the central banks. And we know who they are. It's, Russia and China, but also, Vietnam is a big buyer. I mentioned their trade surplus earlier. Like, okay, what are they doing with the money? Well, one of the things they're doing is buying gold. Kazakhstan, Turkey, Iran's buying it. They're non-transparent, but they're buying it. And Mexico and many others. So the central banks are driving. The inflection point was 2010. From 1970 to 2010, central banks were net sellers. But since 2010, they've been net buyers. But the amount of buying has been going up. I mean, Russia has increased their gold reserves by 5 times. In 2009, they were 600 tons. Today, they're about 3,000 tons. That's a 5 times increase in, it's 16 years, but that's still 500% more gold. By the way, that gold has saved them in the Ukrainian war because the U.S. put financial sanctions and tried to steal $300 billion of U.S. Treasury securities that Russia paid for with dollars that they made by selling oil. When we froze the U.S. Treasury securities, and now we're in the process of stealing them, they stole $50 billion out of the $300 billion to make a loan to Ukraine. That's never going to get repaid. But Russia had put, Elvira Nabiullina, who's the head of the Central Bank of Russia, she had put 25% of their reserves in gold before the war in Ukraine, again, in this period since 2009. Now, here's one of the ironies, and shows how much the U.S. doesn't understand about this. The war and the central bank buying and the kinds of things we've been talking about have driven up the price of gold so much that Russia has made $100 billion of profits on a mark-to-market basis on their gold. So, we froze $300 billion in Treasury securities, but they've been continuing to sell oil and natural gas, and they've made $100 billion on their gold, which thanks to us because we're the ones causing all the problems. So they're the driving force. Now they have to be. Russia has been they've shown a lot of finesse in how they do it. They buy 10 tons a month, 20 tons a month. Some months they skip. Recently they haven't reported anything. I don't think that means that they're not buying gold. I think it probably means they're buying the gold through the sovereign wealth fund instead of the central bank, which is what China does. China's been buying gold all along, but we don't really have hard data because they don't buy it through the central bank. They buy it through their sovereign wealth fund with something called SAFE, State Administration of Foreign Exchange. So they have these pockets where they can buy gold without putting it on the central bank balance sheet. But that's what's really driving the price of gold. And if you thought about it, you say, well, gee, why doesn't China just, announce what they're doing and, bid up the price of gold and make a lot of money? Well, the answer is they're not done buying. See, if you were buying, you wouldn't want the price to go up until you have all you want. When you have enough, that's different. But if you're still a buyer, you want the price to be moderate. So what's going on is a great game involving the major powers, involving gold. There's more to it, but that's what's driving the price higher. Gold is not going up. The dollar is going down.
Right.
Now, as gold is constant by weight, as I said, it's an element. It just sits there. But in the time I've been an investor, it took $700 to buy an ounce of gold. I have friends who bought it $200. Good for them. I'm very happy for them. But I started buying around $700. It used to take $700 to buy an ounce of gold. Today it takes about $2,900 to buy an ounce of gold. The ounce of gold hasn't changed. What changed is that the dollar has collapsed. Now, people keep saying we have a strong dollar, and
Yes.
I hear that all the time. And I look at them and I say, compared to what? Meaning, yeah, compared to the euro and the yuan and the yen and Swiss francs and sterling, yes. But compared to gold, no. The dollar has collapsed compared to gold. So that to me is a better metric. But I'll tell you a secret. Here's what's going on. Everyone's like, where's the BRICS currency? The BRICS are supposed to be having a currency, and they're going to replace the dollar and do this and do that. And Trump said, if you BRICS come out with a currency, I'm putting 100% tariffs on you, 200%, whatever it takes. It's going to be, and everyone's like, where's the BRICS currency? They already have it. It's called gold. Meaning, why would you go out and print up a new currency? If you're Russia and I'm China, and we're trading, I'm selling you, manufactured goods and semiconductors, and you're selling me oil, natural gas, or whatever, and I'm paying you in rubles and you're paying me in yuan or whatever. We have a trade balance, and a lot of it nets out, but there's some net balance. Somebody owes something to the other or whatever. You settle it in gold. And because you're settling on a net basis, not a gross basis, you don't need that much gold. It becomes very feasible. And you can keep it in a vault and change the title, but you can also just put it on a plane and ship it over. So the BRICS don't need a BRICS currency. They already have one, and it's gold.